Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader, and I'm here with your Cabot Weekly Review. So we went over this a few times, but there were some building positives with the market in under the surface, kind of like in February, March. Then we had a really nice 2.5 week rally that turned the intermediate term trend up. It recouped, half of the Nasdaq's decline, more than half, about three-quarters of the S&P's decline, even brought with it kind of a blast-off type measure that usually bodes well, 6 to 12 months down the road and all that. But stocks never really took off on the upside, individual stocks. There was still some selling on strength, and we were due for a pullback. And the question was, how would we pull back? And so far, the answer has been not great. There's been a lot of, I don't want to say a lot of abnormal action, but some abnormal selling, a lot of sloppiness, a lot of the things that looked pretty good that could go on runs if the market had a run. They're the ones that have really taken hits. We've even seen some, not all, a lot of commodity stocks look good, and I'll go over those, but we've even seen some of areas like shipping stocks, stuff like that, get hit. Some things in the agriculture space as well. So it's becoming more selective. I wouldn't say all the good vibes from the past 2 months are gone just because of the last week. That's not what I would say. But just the way I'd put it is, if we were kind of like a 3.5 or 4 out of 10 on a scale of 1 to 10, 10 being super bullish, one being 2008. If we were like 3.5 and 4 back a month or two ago, we got up to 6. Now we're kind of like 5. We're kind of in the middle there, and we'll see how it goes. The intermediate term trend kind of on the fence here. A lot of stocks have taken on water, but not really given up the ghost. So I know I say this a lot, but I do think the next few days will be pretty telling here. If we can bounce strongly, get some show of support for whatever reason, whether it's news or not, there's a chance that this could just be another shakeout and part of the bottom building process. If we just obviously just kind of melt away here. And I'm recording this late Friday morning, not off to a good start today, but we'll see. If we just kind of melt away here, obviously, we'll just have to see how it goes. All right. Right now, I think it's still best to be relatively cautious, good chunks of cash. And if you want to buy, that's okay, but small positions on weakness, that sort of thing. All right. All right. Let's hop in the charts. As usual, I'm using a program called MarketSmith. You can learn more at marketsmith.com. It's a product of Investors Business Daily. Get my pen out here. So here's the Nasdaq. So first and foremost, we're still below the 200-day line in most indexes and most stocks, which is this black line. The S&P, I'll have to look at the chart, but that got above it and some other things, but a lot of stocks not so much. You can just see as soon as it kind of came up and tested it, again, you're kind of getting that selling on strength vibe. In terms of the intermediate term, we're right back down to these moving averages, the 25 and 50-day. There's nothing magic about it, but you'd expect that if this is more of a I don't want to say shakeout, but if it's more of a kind of part of a bottom building process, or I'm not a chart guy, but sort of a reverse head and shoulders or whatever you want to call it, you'd probably end up finding support somewhere around here would be kind of logical. Okay, that's why I just say if we just kind of come in and start melting down and Nasdaq's down 500 points today or next Monday or whatever, that's kind of like, all right, we're definitely back in the soup, if not worse. But right here, at least from a top-down perspective, on the fence. Okay. Now some of the indexes, to be fair, look better. So this is the S&P 500. You can see still above these moving averages, still right around the 200-day line. And the New York Composite, despite some broad market, some issues there. Let's see if we can get this loaded up here. You can see it's kind of all over the place here. But again, it's kind of holding these moving averages so far. We'll see how it plays out. So there's some positive there. And then, of course, the broad market measures are worse. So small caps are, I talked earlier about, it's hard to see on this chart, but let me just say first, you can see I decisively broke the moving averages. And on the weekly chart, I had mentioned a few weeks ago, it wasn't a character change, but you just started to see that the small caps were starting to, I don't want to say outperform, but go down less than the big caps during the correction. But that's kind of almost come back the other direction here in terms of relative to the big caps. So small caps are once again the worst thing out there. Mid caps not that far behind, below the moving average and whatnot. So we'll see how it plays out. I think my bigger thought here, because I don't want to predict. I mean, we could right now. It looks like okay, we're just going to go down, but the way this market goes, maybe we come in next week. It's a good week. My biggest thought though is unless you're in there very nimbly buying and selling, there's no money being made. So I wouldn't be playing anything heavily much at all. You know what I mean? It's just even if you bought something right, you get a pop, the stock does well for 7 or 8 days, and then guess what? It starts to sell off again. And the market just can't sustain anything at this point. Whether this is, like I said, whether this is part of sort of a bigger bottoming phase or not, we'll see how it plays out. On that note, I would just say, and this is, you know me, I don't trumpet sunshine or anything, but these 4 days here, that was sort of the 4 day frenzy or 4 day thrust, whatever you want to call it. 4 days in a row of 1% gains on the S&P, which does have very good, like I said, 6 to 12 months sort of returns. In fact, historically, it's a very reliable signal. Doesn't mean it has to work this time, but I do put some weight on that, or at least I don't ignore it. With that said, when the signal occurs below the 200-day line, which this one did by a hair, just in here, when you go back and look, it's not unusual during the first 2 or 3 months of the signal to get another retest or partial retest or whatever you want to call it. So we'll see. I mean, maybe the S&P comes down here. We have to wait for another earnings season. You know, the Fed obviously is super hawkish right now. I'm not predicting any of this, and I'm certainly not excusing the market doing what it's doing. We're taking action and stuff like that. But, you know, bigger picture, if the market can, even if it does pull back, if it can kind of hang in here, it could be part of sort of a longer bottom building process, especially among growth stocks, which really took it on the chin. Just something to be aware of. We like to look at history as a guide, but that's all it is a guide. Most important is kind of what's going on right now. And we'd say the intermediate term green light, which just clicked, is back on the fence real quick. And obviously not a lot of stocks are going up, and you know more and more are getting cut off at the knees. Okay, in terms of the growth funds or measures, they look a lot more like the broad indexes. You can see this is the QQQJ. Tried to poke up. These things never really turned positive intermediate term. They weren't as strong as the other stuff, which is obviously not exactly what you're looking for. But again, kind of back below the moving averages. IPO, the IPO fund, same sort of thing. These moves look kind of small, but just because it's up fallen so far, and it's an arithmetic chart. But it's a pretty sharp sell-off here from 46 to 41 in just a few days. So, I guess you could say we're back in the soup with some of these things, maybe not, but I would just say, let's see how things play out. But I certainly would have your stops in place. Don't let losses get away from you. And again, just don't play, don't go crazy in this environment, because unless you're in there every 72 hours, there's not a lot of money being made one way or the other. The other thing that's become kind of glaring and obvious is, there's definitely a recession trade going on out there. So whatever that plays out into the real world, but this is the transports, IYT, the Dow Transport ETF. Not a huge dramatic, not a volatile fund, you can see, but it's kind of it was holding up actually okay, but I guess now you look at it almost like topping out. And then the last couple of weeks, you can just see on the daily chart, it's just been awful, and really just no ability to bounce at all day after day after day, whether it's rates or the Fed talk or the war, whatever the case may be. Clearly below the 200-day line and actually hitting new correction lows already. Meanwhile, you have things like the XLP, which I like to watch for defensive stocks. Hey, this looks great. Coca-Cola and toilet paper. These things look great, hitting new highs. Utilities is XLU, which I find interesting because, even though rates are going up, people are piling into utilities. I mean, to me, it's clearly a defensive play, right? They're parked. They have to park money somewhere, so they're not parking it in some of this stuff. Meanwhile, you have things like QQQJ and IPO, and then chip stocks. This was what really first kind of got this latest little down leg, not little, but latest down leg going here. A lot of chip stocks that were looking good just fell apart starting late last month. And you can just see it's really skidding and already testing, the low area here. So I would just say, it's hard to, you don't want to put lipstick on the pig. It's not good. I wouldn't say, like I said, all the good vibes from the last couple months are over or done with just because of the last 5 days. But clearly, institutions, whether it's because of news or something changed or whatever, but they used this rally here to sell into. Okay, they certainly weren't buying and creating more momentum on the upside. They were using it to sell into. Now let's see how it plays out. A lot of things are kind of back into this range, even like chip stocks, but a lot of indexes are just kind of back in this sort of bottoming area range. Do we just blow through it? Hey, this is another leg down. Do we find support? Do we chop around? Let's just see how it plays out. But either way, we wouldn't be playing too heavily there. In terms of individual stocks, so there are still some hanging up. Most of the commodity stuff that's where the action is. But even there, it's becoming a little bit more selective. This is Matson, which is sort of a niche shipper. We've seen some shipping stocks kind of get hit. So this is obviously a breakdown. Zim Shipping, which was a huge winner. In fairness, Zim has had a giant run here in the last many, many months. And again, it has a huge dividend. So sometimes after the dividend was paid, which was a couple weeks ago, you get some selling. But still, I don't want to excuse these things. You're starting to see, some actual accelerated selling volume there. And even Star Bulk Carriers, it's not broken here, but it's kind of just in this choppy range. It had this nice breakout and run. And I had mentioned it, it's like kind of nice shakeout, starting to tighten up. But again, you're just seeing it's starting to infect. This selling on strength stuff is starting to infect more and more areas where even as things look pretty good, they pop up. People are kind of lightening up on those, probably because they're trying to raise cash overall. They're trying to sell what they can, not what they have to. So even Star Bulk, not totally broken, but not looking the best out there. Meanwhile, I do think there are a lot of things in commodity land that look good. So this is Halliburton. I've mentioned it before. What I like about the oil service things is they weren't super hot last year. They really just got going at the turn of the year. Now they've been running here for 3 months, so that doesn't mean you can't correct and break down. But so far it's been very orderly, and I know there's some others too, and I like some of the smaller oil service names. I'll mention one here in a second. But just, respecting this green line is the 25-day simple moving average. Just respecting it, and net just kind of consolidating in here. Maybe it comes down here and all of a sudden you're like, well, this looks a little toppy. But, so far it's not showing. Yes, it has the occasional wild move on overnight news, oil prices in Ukraine or whatever, or the SPR release. But for the most part, it's been hanging in there pretty good. And if you just take out all the day-to-day action, look at the weekly chart, you might have kind of some tightness right up here near its highs. So I kind of think Halliburton is going to be higher down the road. It's my guess. They do have earnings here in a couple weeks on April 19th. So we'll see how it goes. But I do think that looks pretty good. And one other in the same general group, it's a little bit more of a driller. This is Patterson UTI PTEN. Again, you kind of had this, you had the original post-pandemic or post-crash recovery, but then it spent 9 months or whatever doing nothing, accelerating buy volume for many weeks in a row here, and now it's just chopping around. Could it be done? Yes, but all else equal, looks pretty good. Again, buying the breakouts, tough. You're still seeing the selling on strength, so even with the commodity names, I'd be favoring, buying hopefully on dips or at least some tightness, some sort of risk reward area where if you're wrong, you trip out below the 50-day line or whatever, and the risk reward is reasonable, and you take a paper cut, you don't take some sort of huge hit. Okay, but anyway, oil service still looks good. Still like fertilizers. This is Nutrien, which again, trying to gap up today, selling off a little bit, but again, holding the 25-day line. Wouldn't mind if this did come in, maybe another week or two of consolidation. It doesn't care what I want, of course, but there are a couple others that look a little stronger, like in the very near term. But either way, the fertilizer plays have been holding up pretty well. Obviously news driven, but the longer they hold up here, the greater the chance that the next move will be up. Oil Explorer, the actual oil explorers. I kind of like the action recently in the sense that it's been calmer. This is MRO Marathon, but a lot of the charts look the same. There's nothing wrong with these shakeouts to the 50 and rebounds and stuff, but you're kind of getting now a little bit of, even as oil prices come in, you're starting to see volume dry up and all that. Again, not to say the same thing every time. Maybe this is a sign of waning, buying volume, and the next move is going to be a correction. That's certainly possible, but I'm just saying risk reward wise, some of these things have sort of quieted down into 25-day lines or 50-day lines, and I think MRO is one of them that looks pretty good. A little bit of a hotter potato is PDC Energy. They have a kind of an out-of-this-world cash flow thing going on if all goes well. Again, you're kind of had this is in a little bit more of a steeper uptrend, so you've had this sort of coming out party here, and then hits a 25-day line and really accelerates higher, and again chopping to the 25-day line here. The smaller one's obviously going to be more volatile. But either one of these look pretty good. I'm just seeing more of the energy explorers for the first time in a while. Settle down a little bit, volume's drying up, moving average support maybe. So if you're interested, that sort of thing. Some of the agriculture stuff, not so good, but I did just notice Deere. I wouldn't say Deere is the biggest leader in the world, but you kind of have this pattern where you have this massive breakout and run after the vaccine, year-long consolidation. And it's one of these names where, look back here, it's like, oh, here we go, it's getting going. No, the market's not ready. Oh, trying here. No, market brings it back down. As soon as the pressure comes off the market, boom, spikes to new highs. And now it's pulling back here, kind of a nice little consolidation. It did have some selling that was a couple weeks ago, so I don't want to make it sound like it's been painless or anything, or that it couldn't keep going. But again, you kind of have theoretically some support in here. So if you're game for some of these commodity things, small positions on dips, seeing some of these. Steel Dynamics, same sort of pattern as Deere, big consolidation. They raise guidance here. They do have earnings here on the 21st, so just FYI. But a lot of buying volume, steel, obviously, and now you're starting to get this pullback in here. A little bit of selling pressure could easily come in here, especially if the market keels over. But again, with a risk-reward theme. And I'll just mention Alpha Metallurgical. I think I'd mentioned this before. This is AMR. It's a smaller, super volatile coal thing, but it's got a little bit of it's kind of a rare sort of pattern, accelerating higher and just hanging out here. The earnings numbers are almost, I don't know what to make of them, $60 a share this year. I don't know if that's real or whatever, but it looks pretty good. Obviously, the group is working. You kind of prefer to have this thing chill out for a little bit longer, moving averages catch up. But the longer these things kind of hang in here and maybe quiet down, you get a little bit of strength, you get a pretty good risk reward. Still seeing some pretty positive stuff in the commodity fields as of now. In terms of growth stocks, not a lot. I mean, the things that were looking good, I'm not saying they're all falling apart, but you have had some things fall apart. One thing I'm keeping an eye on, cybersecurity does seem like one of the growth areas that's trying to hang on here. It's not like they're all doing well, but CrowdStrike's interesting. I'd mentioned this before, where you kind of have this, it was a 50% correction, so usually that's going to take time to heal. So I highly doubt it's going to be straight up from here. But you did have all this support here at 150. You had the biggest weekly volume in whatever this was, a year and a half. And then you had a nice, pretty persistent rally, really, into the 200-day line. It would make sense for the stock to then pull back from there. This is kind of what we were looking at with the market, is like, how is it going to pull back? Is it going to just, does CrowdStrike hit whatever this is, 230, and then it's down to 190 in 2 days, just a total meltdown? Or does it pull back and bounce? And that's kind of what we're seeing so far. It's normal. Now, check back later in the day, we'll see where it's at. But so far it looks pretty normal. Needs more time to build this sort of huge structure, but it's one that I am keeping a distant eye on. Palo Alto Networks is the other in the group that honestly looks fine. If you didn't know the market was in trouble, you just, higher lows, huge volume clues, higher low here during the final low, a bunch of days up in a row as soon as the pressure came off the market. And then as things are getting hit, yeah, it's come down here, but, relatively speaking, that doesn't look too bad. So obviously, if the market keels over, it could keep coming in, but there's no doubt that looks pretty good here. The other theme is really medical stuff, and I'm going to be doing some more work on this. So biotech and medical devices. I'm not talking the XLV. There's a lot of talk about this, and it looks good. I'm not complaining. But to me, this is more defense. So it's big, stodgy, dividend-paying, cheap companies. Nothing wrong with it. I hope you own it. It's doing well. But to me, this is something where, if the market got going, it wouldn't surprise me if this kind of sold off a little bit. I'm sort of more looking at the growth-oriented, as usual, growth-oriented medical stuff. So this is Shockwave, SWAV. Now, this thing had a huge run, and then again, it fell 50% ballpark during the growth stock meltdown. Usually these things take more time to heal. So meaning it might run up here and then spend another 3 months just, consolidating, or if everything's okay. But I'm just sort of flagging it as it hit its low in January. Back here, you can just see the higher lows when the market was weak, popped above the 200-day line, and really no give back yet. Okay, at this point, does it look like a great entry point? Not really, right here. But at this point with some of these things, I'm just sort of flagging strength. Inspire, I've mentioned this. This is the sleep apnea one. This one's had a little bit more time to sort of chill out. It's basically gone nothing for a year. Not the best looking week right here, but just net. When you look at some of these things, higher low during the correction, nice run here, and yes, pulling back, very volatile, a little thinly traded, but overall the pullback, not too bad, and sort of into some support. So we'll see how that goes. Halozyme, I think I mentioned this a couple weeks ago, maybe. This is an old love affair of mine. We owned it back here and pretty much broke even on it. It got going and got hit. They're kind of a royalty story, and the royalties are going to be picking up big time here going forward. Actually bottomed out pretty much in December. The RP line bottomed in December. double bottom. Now it's again kind of back above the 200-day line. It's still 20% off its high. There's still old overhead to chew through. But again, so far, it certainly looks more like it's sold out to this point than that there's a bunch of sellers left in there, like some of these other stocks, okay? And then Lantham, I've mentioned this, LNTH. This is sort of a new kid on the block. This was your 10 times average volume gap. And it is, again, these things are smaller and thinner, so, you can come in on Monday and poof, but you could say that about a lot of stocks these days. This one, nice big shake. I won't say nice, but big shake to the 25-day line, found support. Wouldn't surprise me you get another shake here. At some point, it's going to meet up with a 50-day line. Odds favor, big earnings growth this year and going forward, new product, that sort of thing. Wouldn't surprise me if you get a shake, but it should be buyable, depending on if the market, what it looks like. Just a couple other things here as I'm looking at my notes. This is sort of neither here nor there. This is Five Below. Great long-term cookie cutter story. It's not ready to be bought. But again, I'm starting to see some of these things trying to bottom out here. Now you got, big drops. If you fall off a bike, you scrape you get a Band-Aid on your knee. That's it. When you fall off a motorcycle going 60 miles an hour, you probably have to stay in the hospital or stay off the motorcycle for a few months. Okay. And that's kind of like what it's like for stocks, not to be so blunt. When there's a lot of damage done, it usually takes time. It doesn't just bottom and go up. Sometimes it can, but usually it doesn't. It usually takes time to repair the damage. And that's what, starting to see some of these, trying to find some of these names that are not buyable, but have been bottoming out. And then maybe if you get a gap, all of a sudden you got something to work with, or, let's see what happens. But anyway, Five Below, you can just see a couple months now working in here. Yes, there's been some selling, but net, it's trying to do okay. And last but not least, just to flag this isn't really growth, but this is, LPL Financial, which I've mentioned, LPLA, and actually let me just show you first. I'm going in a couple different directions here. Sorry about that. But this is XLF. Even though rates have gone up, even though the Fed is talking jawboning, I think there's been more, like I showed you with the transports, there's been more of sort of a recession trade. So it's like, oh, the banks are in trouble and the inverted yield curve and whatever. So you've had this weakness in the financials. Not totally back to its lows, obviously, but not looking too good. Certainly one of the leaders on the downside here during this last week or two, and you see it with Bank of America, back towards its lows. I think Citigroup looks like garbage. New lows here. I think they have some Russia issues, but anyway, you have a lot of that going on. Let's see what Goldman Sachs looks like just for the hell of it. Yep, new lows in Goldman Sachs, or at least new correction lows. Okay. But then you have LPLA, which is sort of a broker dealer, not a broker dealer, but a bull market stock, and they are going to benefit from higher interest rates. But so are a lot of these other stocks, and they're getting hit. But this one's hanging in there and actually almost at new highs. So I find that kind of interesting. And the weekly chart is there in terms of this is one of those I tried to get going a few times, but the market keeps pulling it back. Now it just seems to be not wanting to pull back. And you have the big earnings estimates this year and next. Again, if the Fed backs off, it could be news driven, but I'm just sort of flagging that as sort of an interesting dichotomy from what you're seeing from a lot of the group. Okay, back to the market. We'll see what happens. It's not looking great here. I mean, it certainly seems like since the Fed came out, they really started releasing a bunch of speeches. I don't trade on that, but when every day they're saying, yep, 50 basis points, yep, no, we're going to tighten, we're going to run off the balance sheet or whatever they're talking about. It certainly seems like institutions have taken that to sell. Okay, so I definitely think you got to honor your stops. If you bought some stuff and you're at a loss, dude, keep a stop in place. Take the small loss. Don't take the big loss down the road. That said, let's see how it goes. I'm not. There's a lot of people out there it's recession talk. It's inflation. It's stagflation. I'm not saying it's 2008 in terms of sentiment or anything, but there's a lot of people just sort of assuming we're going to come down here and retest the lows. We certainly could. We're 50% cash in Cabot Growth Investors model portfolio, so we're certainly not flooring the accelerator. But let's see, and we'll sell. We got a couple things on tight leashes, so stay tuned. We could be pretty defensive pretty soon, but let's see how it goes. Okay, I still think some of the positives here that built up over many weeks, some of the positives that came up in terms of this rally, they haven't all been wiped away here during the last week. So I do think the next few days are interesting. If we do melt down, clearly I wouldn't fight it. But if we do find some support in here, I'm not saying it's off to the races, but I do think there's a decent chance where you can kind of get almost like we were saying with Five Below. Maybe this is just part of a prolonged sort of bottom building phase, where more and more stocks bottom out over time. and eventually the market's ready to go. It's just not ready to go right here. Okay, right now I think it's time to be cautious, not in your storm cellar per se, but relatively cautious, especially on the buy side, and then use the market here as a feedback mechanism going forward. Okay, that's all the time I have for today. As always, thanks for listening, and be sure to come by again next week for another Cabot Weekly Review.